Emily, with that talk around bonds, I had a question just that I'd seen. Why would you own bonds now in this rising interest rate environment at all?
Yeah, it's a great question and a fairly complicated one that I would encourage, continued conversations with your advisor. But we have to bear in mind that the bond market is much more complex than the stock market is, and so there's really not one universal bond market. There's a government bond market, there is a corporate bond market, there's a municipal bond market. They all kind of act differently. There's also different strategies to investing in the bond market, right? So you can invest similar to the stock market where you're buying and selling actively inside of the bond market, or you can employ more of a buy and hold strategy, right? And so in rising rates like this, employing more of a buy and hold strategy, at least for shorter term bonds, might make more sense and is often the strategy that Summitry employs. And so what that means is that even though interest rates are rising, and rising interest rates, so if you think about how a bond would sell on the secondary market, if I own a bond that I bought 2 years ago that is a 5-year bond paying a 1.5% coupon, and today a 5-year bond comes out on the market and pays a 4% coupon, if I tried to sell my 1.5% bond, it pales in comparison to today's bond, right? So I would have to sell it on a deep discount on that secondary market and take a pretty significant loss on it. Versus if I held onto that bond and said, I'm not going to sell it on the secondary market, I'm going to wait until it matures, I'm going to collect the coupon and the face value of the bond back, and then I'm going to reinvest into today's bonds. You can see the difference of taking a loss by selling it on the secondary market versus holding on and realizing a small gain. And so there's always a balance there, right? Sometimes it does make sense to sell it on the secondary market if the benefit that you can reap from that is so great that it offsets the loss that you have to take. But oftentimes employing more of a buy and hold strategy in rising interest rate environments can allow you to kind of benefit from the structure of bonds, right? The guaranteed interest rate structure of bonds. And also, Summitry does employ something called bond laddering, which, given a couple of years to really mature into inside of your portfolio, can be really effective. It basically is saying, I might hold a bond that matures in 2020, or in 2022, in 2023, 2024, 2025. And as those bonds mature, I'm having ongoing liquidity. So I'm kind of flush with cash every year. I'm able to buy new bonds that are, maybe 3-4 years out and offering a better interest rate. And I'm able to participate in the rising interest rate environment. But I'm not having to sell on a secondary market to get that cash, right? And so consistently, as bonds are coming due, I'm able to invest 3-4 years down the line, get a better interest rate, and also the bond ladder is providing me with ongoing liquidity. So I don't know if either of you have anything to add to that, but I think that's typically how I start that conversation with clients.
Yeah, well, I think bonds themselves, again, you have to remember that they have a fixed rate that you're being promised by the issuer. So when you go in, you're essentially entering into a contract with them, and they will guarantee the 4% rate as long as they remain liquid and have the ability to do so. So again, buying bonds, you want to make sure you're buying high quality issuers. Most people think that bonds, you can't lose money, and that's not true. If the issuer ends up going bankrupt, you would lose out on that. So again, you buy high quality, but then when you join the contract or purchase the bond itself, you're in contract with them, and they will pay you this coupon rate. And over time, if we're facing an inflationary period and prices are going up, they're not going to increase that rate along with it. They said, you agreed to this, we will pay you that. And so that is one of the reasons why we do ladder the bonds, is we don't want to put them all into one basket, all maturing in 1 year. We want to be able to spread those out over time. So we're getting hopefully increasing yields over time, but we're taking advantage of what is available at that current time as new money comes available. So that was just a little added benefit that I wanted to share.
Well,
on structure.
And Eric, I really like that you bring that up, because there are some specific risks in the bond market that don't exist in the equity market. You mentioned one of those being credit risk, being that a company may not be around to pay that bond when it does mature, as well as duration risk. And I think that's something we've been identifying and observing here at Summitry, and probably something you've heard as a buzzword on the financial news of yield curves, and making sure that that duration risk is aligned with where the yield curve is at this time. And that is something that our fixed income research investment committee and research team are focusing on, making sure that we're optimizing that for where we find ourselves now going forward as well.
Correct. Yeah. So again, if you're entering into a contract with somebody or a company, you would expect the longer they hold on to your money, you need to be compensated for that risk that you're taking. And so therefore, going out longer term, you would expect a higher interest rate. And so with the rate increases that are going on, it's sort of discombobulated the market, where at one point in some cases, you can actually get a shorter term holding that will pay you a higher rate than what you would get for a longer term holding. And so again, when we see rate increases, it does change the way we are looking and evaluating the bond market, but we want to make sure that we are staying on top of that for you as we go. And so that's why the bond market can be difficult to navigate at times.
Yeah, I think it really drives home the point that, obviously having a good money manager in the stock market is very important, but I would argue that the bond market being a little bit more complex and a little bit less transparent, I really think that the benefit of a money manager, especially in times like this, where things are kind of changing on a daily basis almost, is incredibly important.